Hello, everyone. Thanks for joining us today for today's webinar. I'm your host, Brian Rogers, and I have a really important question for you. What does your retirement look like? For many Canadians, it's a simple question with a complicated answer. We want to kick back and relax. We want to spend more time with friends and family. We might want to travel the world if we can manage it. But how we get there isn't always clear. After all, saving and investing for retirement can be challenging. Figuring out how much to save, which investments to choose, and how much you would need can all be a daunting task to look through. And there are many unknowns that can alter our best laid plans. It's easy to see why 40% of working Canadians surveyed in 2020 by the Canadian Institute of Actuaries said they were unsure when they'll retire. Meanwhile, 1 in 4 polled by Natixis last year said it's going to take a miracle to retire financially secure. Well, there are ways to simplify the process of saving and investing for our golden years. And that's what we're going to discuss today. So joining us is Brian C., Chief Investment Officer at Evermore Capital. His firm's goal is to help Canadians build up their nest egg and gain a little peace of mind as they do it. And even though he spells his name with an I instead of a Y, I'm still excited to ask him some questions about ways to simplify investing for retirement. Brian, thanks for being here with us today.
Yeah, great to be here. Thanks, Brian.
Excellent. Hey, now, before we dive into our discussion, I wanted to toss out a trivia question. I know everybody loves trivia about retirement savings in Canada for our audience to ponder. So, how much money did the average Canadian household hold in private pension assets such as workplace RSPs, personal RSPs, RIFs, and LIRAs, and things like that as of 2019? We're going to reveal the answer at the end of our conversation, so stay tuned for that. Now, before we get into some specific approaches to investing for retirement, let's lay some of the groundwork. Many Canadians know they should save for retirement, but they don't necessarily understand how to go about it. What are some of the key considerations that might help them figure out their retirement plan? What do you think about that, Brian?
I would say, about retirement, the first thing to understand is retirement is really a lot different than typically saving for your regular financial goals, such as a down payment for a house or buying a car or anything like that, for really two reasons. Retirement is much longer in time horizon. You're saving for something that's 10, 20, 30, 40 years into the future. And then the second part is once you do save that nest egg, it's got to last for many years in retirement. So it really makes it different than the typical financial goal that you would have in mind. Speaking of goals, that's also the one thing that I would stress is just having a goals-based approach. Figuring out what your expenses are in retirement and then your spending needs and trying to determine a target and reverse engineer that to make the process cleaner. So once you have that, you can start that as your first step in your plan in terms of retirement planning. A few other things to consider is for retirement saving, the earlier you start saving, the better it is for retirement. The reason being is the longer time period you have, the better chance to allow that magic of compounding to work for you. The other couple things I would also mention is this understanding your cash inflows and outflows. When you're working in your working life, you've got your income coming in from a job. But once you retire, you obviously don't have that. So trying to determine what your additional streams of income are that will replace your existing employment income. Whether that be your company pension plan is one of them, your government benefits such as a CPP or OAS, or your registered accounts such as a TFSA or RRSP or LIRA accounts. Try to determine all those cash inflows and budgeting that to get a sense of what is that income that's coming in. On the flip side, there's also the cash outflows or expenses. So, when you've been working, we've all have our expenses, grocery bills, utilities, mortgage, and so forth. But once you're in retirement, you've been working a majority of your life, and a lot of the major expenses, such as paying for a house or your kids, they're often gone already, and so expenses should fall. Once you lay out those cash inflows and outflows, it can help budget your retirement goals a lot better.
So many Canadians do have a hard time figuring out how much they need to save and invest each month for their retirement. So what's a simple way they can find that magic number?
Yeah, the magic number it's quite the concept, and it also depends on a lot of factors because everyone's income expenses and lifestyle that they want to retire. It's going to be different. Everyone's financial needs and goals are going to be different. Now, that said, when we were actually devising the retirement ETFs at Evermore, we actually analyzed the retirement market in general holistically. So by analyzing academic papers, Statistics Canada data, and industry reports, we're able to get a better sense of what retirement looked like for the typical Canadian. One of the important concepts we came up with was replacement ratio. Now, what that is effectively how much income does a retiree need to replace when they're actually in retirement? So, for example, say you were earning, say, $60,000 during your working life, and then when you retire, that $60,000 is gone. So, how much of that do you need to replace? And what we found based on our analysis was about 50% actually. So you might say, whoa, well, that's quite a small number or big number depending on your preferences. But generally, if it's 60,000, you'd only need, say, 30,000. And the reason for that is because a lot of your major expenses are gone. I think earlier we talked about the fact that a lot of Canadians have their housing paid off if they've been working for 40 years. So that's a major expense that's gone. If they've got kids, they've moved on, they're adult children, they're gone. You don't need to pay for their expenses anymore. As well as when you're in retirement, your tax brackets are generally lower. So the taxes is an expense that you've been paying through your working life, and that's gone too. And the fact that you're in retirement, you're not saving for retirement because you are already in it. So a lot of these things are removed, and that's why your expense levels fall naturally as well. Now, Brian, to your, to be more specific in your question, you wanted a magic number. And so I could say that, we were trying to solve for that too. And based on our products that we generated and built, we came up with a number of about 5% based on your income, moving up to 10% as you go through your working life. So 10% at age 65. It moves up naturally in a linear fashion. And this actually corresponds to about, the amount of RRSP contributions that most Canadians have been actually making. So it just coincidentally matches with that. But generally, based on our products and our analysis and the data that we have, we found that starting at 5%, moving up to 10% was a good number for Canadians to utilize.
Well, yeah, that sounds pretty easy to remember, right? You can think of 5% of your income per month. So you've emphasized the importance of staying consistent. So that's the other, you said that's a hard thing to do, having the discipline, staying consistent with saving and investing for retirement, but it can sometimes be difficult to follow through. What can Canadians do to make this a little bit easier?
Right, saving is a key goal to retirement. It's probably the most important goal. So a lot of strategies that Canadians can deploy is something like setting up a monthly contribution plan or systematic investment plan. That way you're taking that money automatically out of your account and investing it for a financial goal or retirement. So I think that is a good first step to ensure that you are saving an appropriate amount. And the reason for that is because often I think a lot of Canadians, and I've done this myself, and I think many people have done it, where we get our paycheck every 2 weeks, we pay our expenses, other things come up that you want to buy, and then you have nothing left over because it's much easier to spend that money there. So, the other way to do it is just to do the opposite. As soon as you get your paycheck, take off that money and put it into retirement. That way it's locked away and put away, and that way you can actually meet your goals. And this is a facet about trying to be disciplined with your investing. So that's one simple change in behavior that Canadians can do. Another approach is to take that tax credit you receive from contributing to RSPs. So a lot of times, a lot of Canadians will contribute to RSP, they reduce their tax bill, they get a credit back. You can take that amount and invest it into your retirement planning to further meet your goal. And again, it helps compound your investment. So another facet. And then the third thing is taking advantage of company-sponsored pension plans or RSP plans. A lot of the times, an employee can contribute, say, 3 to 5% of their income, and then the employer will match that 3 to 5%. So it's a great way to compound investing for retirement. A large part of all of this is just being sensible and staying disciplined and making sure you continue to invest.
Yeah, when you get that tax return, there's kind of that temptation to go on a shopping spree, right?
Of course, of course. But you got to resist that temptation and do it for what you're trying to do for the long term.
Absolutely. No, I love that. So now where you save and invest your money is also important. So most Canadians are familiar with an RSP and a TFSA, which both have their own benefits and drawbacks. What are some rules of thumb that can help them decide which one would you want to prioritize?
Right. The TFSA and RSP, they're both great investment vehicles. Let's bring that out first and foremost. Now, there's no blanket answer to say, well, this one's better versus that one. Ideally, you want to utilize both of those to your advantage. So if you look at, say, let's just take the tax-free savings account. I mean, this year you can contribute $6,000 tax-free into this account. So any returns you make are not taxed at all. So that's a huge benefit. One of the positives for the TFSA is, you can always withdraw that money in the short term if you need to. If you have some short-term financial goal, you can take that money and those returns out and not be taxed on it at all. So it gives you that flexibility is what a TFSA does. When you contrast that to an RSP, it's another great vehicle. By contributing, like we just talked about, you get a tax credit and then you defer a lot of those returns into retirement when you do need to withdraw that money. And the huge benefit about that is because when you do ultimately withdraw that money in retirement, you're presumably in a lower tax bracket. And so you're going to be deferring that tax, which helps as well. So you can build your investments over the long term. One of the considerations to think about an RSP is, it might be utilized for someone with a higher income tax bracket as well, because the higher you go, you might want to take those tax credits and bring back and be more tax efficient. So that's something to consider. RSP, of course, when you put that money in, if you do want to withdraw it, you're going to face a tax penalty. So that's something to consider. But on the flip side, that could be, again, goes back to investing. If you know that there's a tax penalty there, you might keep that money in there for the long term and wait for it until retirement. So that's another way to think about, deciding between the TFSA and RSP.
Yeah, I think that I agree with that. That's a great incentive where you're just like, oh, I don't want to get penalized. I don't want to get taxed extra. So you might
Yeah,
leave it in that RSP longer. Yeah.
absolutely.
All right. So we often hear that diversification is important to consider when investing for retirement. So why is that exactly? And how can an investor determine if they're diversified enough?
Right. So diversification is one of the most important pillars of investing, just overall. And the reason it's so important is because when you diversify, it helps you curb your overall risk in the portfolio. For instance, if you have a portfolio of, one or two names, that portfolio is going to be determined by those one or two stocks. So if they go up, that's fantastic. But if they go down, that's pretty bad too. So it's all dependent upon that. But if you've got a diversified portfolio of several stocks or investments, the ones that go down are going to be upset by some that go up. And so that's the power of diversification, right? And, it doesn't even stop at the company level. We just talked about stocks, and it's good to hold lots of stocks, but we should also consider diversification across all aspects. So asset classes, it's good to actually have a mix of equities and fixed income. So equities can be offset by fixed income and vice versa. So that's another thing to think about. You can also diversify across geographies. Sometimes you might have everything based in the United States or Canada. Well, then you're at the whims of those countries' investments. So you might want to diversify globally as well. The other part of diversification often involves sectors. So sometimes you hear about all the tech stocks that we've been hearing in the news for several years, and that's great. But sometimes you might want to have other sectors, energy, financials, consumer. So it's important to be diversified across all aspects and not just one specific category. Now, when you're talking about diversification, it's really easy today for an investor to get that diversification. Historically in the past, you would have to buy, many investments and have to monitor all of them. Today, you can actually buy a very low-cost ETF and build the portfolio for yourself for a very low fee. That way you can get access to thousands of securities all across worlds, all across sectors, and then build that efficient portfolio at a very low cost. And so I think that's something to consider as well, where you're looking at fees and it's cheaper to do it that way.
So there are very often fees associated with investing platforms and financial products specifically too. And you say this is something Canadians need to keep in mind when saving for retirement. Just how significant a difference can fees make to an investment portfolio's return?
Well, fees are very important in investing. So when you think about fees, those are the fees that you would have to pay for, say, like a mutual fund or an ETF. So when you're thinking about management fees, some they can be upwards of 2% or even more for some actively managed products. And then on the flip side, you might look at some ETFs and they could be 0.5%, for example, on average, but there are also some that are higher. So it's a wide range. The easiest way to think about this, and I think I've got this graphic on the screen to show what the impact of fees. So just imagine that you had two investment products out there. So the same securities, same market makeup. And then the only difference is the fees. And so if you invested, $5,000 every single year, which is not an unreasonable amount, $5,000 a year, just a little bit about 400 a month, every single year for 40 years, okay, you would end up in a 2% fee portfolio, $800,000 at the end of 40 years. So that sounds like a lot of money, right? $800,000 after 40 years, it is a good amount of money. But if you contrast that with, say, the exact same product, but at 0.5% fee, you end up with $1.2 million. So that's a significant difference. Remember, it's the same product across the board. The only difference is the fee, 2% and 0.5%. So when you say, well, the difference is 1.5%, that might not seem like a lot of money, but I think we've just illustrated, compounded over many, many years, it is a lot of money. $400,000 difference. I don't know about you, Brian, but to me, that's a lot of money. And I can think about a lot of things that I want to do with that amount. So again, I think that puts into context the power of fees. So sometimes when you're seeing quotes and you're looking at how much you're paying for these fees, just think about it compounded over many, many years. So just like compounding positive returns is a great thing for yourself, you can also compound negatively with a high fee structure. So I would encourage that's something that investors should definitely look at.
Okay, well, that all transitions us nicely to some passive and simplified approaches to investing for retirement that we can consider. So the first one we'll touch on is investing in mutual funds. So, speaking of fees, we know that they're often associated with those types of investments. But what are the benefits and downsides of this approach of using mutual funds?
Right. So mutual funds, they're familiar products. They've been around for many, many years, and I think most Canadians are familiar with them. So I think when you're thinking about mutual funds, the benefit, of course, and the positive of a mutual fund is that you get a professional portfolio manager overseeing your investments. So they're transacting different securities, they're overseeing that portfolio according to the market, and they're making decisions as market conditions change. So I think that's definitely a huge plus. The second thing is mutual funds are generally highly diversified. The investments should hold, in most cases, lots of securities. So it helps with that diversification aspect that we talked about earlier. And an investor could choose funds that are also right for them because there's so many mutual funds. So you can look at your own individual risk-reward characteristics and then decide which mutual fund that you want. So there's good flexibility in that regard. I would say on the downside, I think in most cases, particularly actively managed mutual funds, the management fees are higher than traditional investments such as in passive index ETF per se. And we just talked about how the impact of fees. So that's something that investors should look at for sure.
So what are some considerations that Canadians should keep in mind when selecting mutual funds for their retirement portfolio?
So when you're actually looking at mutual funds, I think it goes back to some of the first concepts we were talking about. We should define what our investment goals are. So when you're looking at mutual funds, define what your risk tolerance is, define what your return objective is, and your time frame. Because then you can narrow down that large mutual fund universe of investments. That way you can better pick a mutual fund that better meets your goals. Once you do that, you can then look at that universe of mutual funds that you want and say, are these mutual funds appropriately diversified? So you want to check that box as well. And then again, figure out how much you're paying in fees. I think once you start to do that, then you can make a more sensible and appropriate choice for your investment goals.
Yes, and you want to be careful of like analysis paralysis too. I know there's so much out there. You don't want to spend too much time looking for that.
Of course, of course. So keep it high level, and then you should, work from there, and then you should be okay.
Oh, great. Thank you. So next, let's talk about Robo Advisors. So as a child of the 80s, I always wanted my own personal robot. I don't know if you're the same.
Of course.
But I never thought of it helping me with my investing. Can you walk us through, how they work in a nutshell, if you can let us know just briefly, and the benefits and downsides of the robo investing approach?
Yeah. So robo advisors, they're not like an actual physical robot that shows up at your home and helps you invest. So we'll cross that one off the list. But they're generally digital platforms with automated services. So there's really no fund manager behind these investing activities. Really, you as an investor go online, you sign up. There's an algorithm that trades around certain parameters, and so investors would come in, take a survey, determine what their risk tolerance is, their investment goals, and then they're paired with some robo advisor led funds. That's typically what a robo advisor does and how the product works. These funds are generally invested in passive type indexes, and they're highly diversified. So that's always a plus. In addition to which, the fees are generally lower because you don't have to compensate for an actual portfolio manager to be there, right? So those are some of the benefits of what robo-advising is. I'd say some of the maybe the drawbacks that people could consider is that it's a one-size-fits-all type of investment. So we talked about earlier how people's have different financial needs and goals and so forth. So a robo-advisor sort of slots you into kind of a makeshift product there. The other thing is that once you determine what robo-advisor funds you are, your financial circumstances are changing as the years go by. And so you have to manually go back into these systems and update that. You can't just set it and forget it. So that's another consideration that investors might want to take note. And so at the end of the day, you might want to augment that with another investment product as well to consider for investing. And then finally, there's no human contact or interaction, right? So some people, I know myself personally, you might want to see somebody who's actually managing, or at least can read about that portfolio manager per se, to give you some peace of mind per se. So those are the things I would say to consider about robo-advisors.
Okay. Yeah, it sounds like somewhere in between like that self-directed and even getting like a full service, right? You've got throwing
Right.
that technology in there and making it more automated. Let's look at a new approach on the market. So something you're extremely familiar with, and they're target date retirement ETFs, which Evermore Capital has pioneered. How do they work and how do they compare to mutual funds or robo-advisors?
Evermore retirement ETFs were the first target date fund ETF in Canada. And these products are designed for retirement. So they're designed to be held in your RRSP, LIRAs, TFSAs. And how they actually work is they're effectively an asset allocation fund. So what that means is an asset allocation fund usually has a balance of, say, equities and fixed income. And that mix will adjust as the fund goes through its target date. And so, for example, say you were invested in an Evermore Retirement 2060 target date fund. In the beginning of that fund, which is really 40 years away, you would have a higher weight in equities and a very little weight in fixed income. And as you go through the years and into the target date and through the target date, that balance of fixed income will increase while the equities will decrease. You need that because risk needs to be reduced closer to retirement. When you're thinking about target date funds in general, these products were predominantly offered in company-sponsored pension plans or retirement plans. And so if you worked at these companies that offered them, you could invest in these products. And so if you're one of the fortunate Canadians to work at these companies, you had that. For the rest of Canadians, they didn't have access to those target date funds. So what we've done in Evermore, and this was a gap that we identified in the market, was that by offering target date funds in an ETF, all Canadians, millions of Canadians, could now get access to target date funds. We touched on Robo Advisors earlier, where Robo Advisors do similar asset allocation processes. The difference between target date funds is you'll have a portfolio management team overseeing that allocation over the years. So whereas a Robo Advisor, you'd have to go in and do it yourself, target date funds automatically do that for you. So it offers you a one-ticket solution and a peace of mind, so you don't have to keep rebalancing your investments year in and year out. I think that'd be a big difference between the robo-advisor and a target date fund. When you compare our target date funds to mutual funds, fees are a big difference. And I think we touched on fees earlier. The average target date fund mutual fund fees are over 200 basis points or 2%. The Evermore retirement ETFs are 45 basis points, so a quarter of the industry average. And again, that allows an investor to keep more money in their pockets.
All right, so these target date retirement ETFs operate based on a so-called glide path that specifies how they will change their asset mix over time. What goes into determining this glide path?
So when you think about the glide path, that is that mix, that asset mix between equities and fixed income. And just to dive into more details on that, generally early in your life, let's go back to that 2060 example. Early in your life, it's going to be highly weighted to equities. In our case, in that 2060 fund, 95% equities, 5% fixed income. And that's because you have that time frame to withstand volatility, but you need equities to grow that nest egg. So you want to have that high weight in the beginning. As you shift toward the glide path, which is really just a mix between equities and fixed income, The fixed income exposure is going to increase. It goes into retirement at about 55% fixed income and 45% equities. And that's really the optimum mix that we found for retirement, at least for the products that we're bringing to the market. So that's essentially what the glide path does. The reason we came up with those mixes, just for for educational purposes for our audience, is we really analyze this from an efficient frontier perspective. So finding the best securities for the highest amount of return for a given level of risk, and that's what it means by efficient frontier. We ran millions of scenarios and Monte Carlo analysis on these products to minimize what we call the knockout risk, which is really the chance of a retiree outliving their money, because that's definitely not what you want to happen. So we really honed in and made sure and ran rigorous scenarios to ensure that that was the case, that the knockout risk was minimized.
Okay, great. So target date retirement ETFs naturally change their asset allocation as investors near their retirement years. I'm getting that. But what might an investor do if it looks like the returns during those early kind of higher risk years won't yield enough to meet their retirement income expectations?
First, retirement is a longer term goal. So you have to understand that you're investing for, like I said, 10, 20, 30, 40, 50 years. So patience and time is required. You need the effect of compounding to take place. And if you do have that short-term underperformance, you might be tempted to sell. That's also probably the wrong time to be selling, because then you lose out on that effect of compounding. Retirement is a longer-term game. And while no investment can guarantee performance, what we can try to ensure is the longer you stay invested, the more disciplined you are, the better chance you do have to meet your retirement goals. So I would say that. The other aspect I would talk about is just, people's financial circumstances may change, and that may warrant switching out a product. So maybe you're in that, let's go back to that 2060 Evermore retirement ETF, and say, your retirement circumstances change, i.e. you had more money, or you plan to retire, say, 15 years earlier. You want to retire in 2045 now. So this would be a great problem to have, but what do you do? So then it'd be warranted to sell the 2060 ETF and buy the 2445 ETF. That way you're matching your risk and return profiles of when you expect to retire. So I think that would be a prudent case where you could do something like that. But I would definitely not be selling out of something just because of short-term underperformance.
Oh, yeah, great. All right. Well, thanks so much for filling us in on these three approaches to simplified retirement investing, Brian. We're going to kick off our live Q&A, but just before we do so, if you guys remember, I know it may be the moment you're all waiting for, is we're going to get the answer to that trivia question. So as a refresher, here was the question. So how much money did the average Canadian household hold in private pension assets such as workplace RSPs, personal RSPs, registered income funds and locked in retirement accounts and things like that as of 2019? The answer is 345,000 and some change. So 345,400 according to data from Statistics Canada. So now that may not sound like enough for retirement, and for many Canadians it probably isn't. But a 2018 survey by the Canadian Payroll Association showed that Canadian employees estimate they will need at least 500,000 to a million for retirement. So like some of the things you said, Brian, you might have some things paid off and those large expenses taken care of. So it may not be as large as some people think. But however, keep in mind, this figure from StatsCan doesn't include public programs such as old age security, guaranteed income supplement, and Canada pension plans. So that's another thing to consider as well. It also does not include money held in TFSAs or non-registered accounts or non-financial assets such as real estate, vehicles, or equity in a business, for example. So there are other sources of income that may contribute to the average Canadian's total financial assets come retirement, but we thought you'd find that interesting. Around that 350 or 45,000 is the average. Did you know that, Brian?
That was an interesting number, actually. So it's news for me. So I appreciate you sharing that
Oh,
statistic.
you're quite welcome. All right. Well, thanks so much, Brian. And we're going to head over to our live Q&A.